And let me begin with the official cheers. Yes, guys, this is water. I know we started this thing out years ago with whiskey. We moved to coffee. Now we're down to water. It's all good. Welcome to another edition of Happy Hour with Doug. If this is your first time by, welcome. And also to my repeat visitors, welcome. But this is where I will do my best to answer all of your stock market related questions. I will often tell tales and rant of stock market topics, that's for sure. But most important, the very foundation of a good old happy hour is to share my 2 decades of trading experience with you guys, just so you can become better traders and more prepared traders and ultimately become successful. That's what I'm here for. And perhaps like no other time in history has my experience been needed as right now. And we're going to talk about that today. Now, before I start, obviously, I want to remind you guys or draw some attention back to the part-time trader program. Long story short, this was something that I started a decade ago in addition to my day trading, where I said I wanted to start giving everyone 1 to 2 just quality actionable trade ideas with research every single week. Well, since then, the count's up over like 1,300%. No joke. It was actually a really small account, much higher balance now. But that's not the most important thing. The most important thing is that it's been very consistent. Last year, 65% return, already off to a good start this year. And it's really something that I feel that fits everybody's lifestyle. Whether you're somebody who's day trading and you can't pay attention to investment assets or swing assets, or you're somebody that has a 401k and looking for a little bit longer time horizon, I think you'll find a solution there. And it's actually performing very, very well over the last several years. So if it's something that you're interested in, somewhere on the screen will appear a link, or it'll be down in the description box. You can see the historical results and learn more about the program. Hope I see you there. So what I want to talk about here today is something I'm seeing that I feel is important for me to discuss. And we talked a little bit about this in the last few videos. We're all fully aware now of the GameStop situation, many of the players involved, and what has happened there. But some of the things I'm seeing here absolutely leave me dumbfounded. And I'm talking to you guys out there who are the diamond hands YOLO people. Because I think what you're doing right now might be one of the dumbest No. It is the dumbest investment strategy and the most ignorant way to do what you're trying to do. Because you think you're out attacking the hedge funds. You're blaming hedge funds for the manipulation and the destruction of the United States stock market, when in fact, it really isn't the hedge fund. The king of all kings when it comes to market manipulation, and where you should be directing your anger. And don't get me wrong, I love a good old-fashioned protest. I love a good old movement. But you should be taking that movement and moving it towards something else, because the culprit of all of this is the Federal Reserve. Now, during this talk, I will explain, so please stick around. Because again, where you are pushing your anger is probably in the wrong direction. Now, why I feel this is my personal public service announcement is while everybody's thinking they're sticking it to the man, the hedge funds, since GameStop has started, it's actually these very hedge funds and people that you claimed manipulated the market have profited more than ever during this whole event. While many of you out there have put your life savings or a big chunk of money that you've saved into this GameStop as a revolution trade with your diamond hands, and unfortunately the rich continue to get richer, and when this is all said and done, the person that will suffer will be the little guy, the very little guy that was supposed to prosper. And I don't simply want to see that, because many of you will lose everything, and you may end up taking food off your table for your family. And if there's anything I can do about it, I'm going to do something about it. So again, stick around. So let's talk about hedge funds here first. And again, as I go through this, I want you to understand, I have no sympathy for hedge funds. I said that in my other ones. I'm just simply going to tell you how business is done, so perhaps many people will understand, number one, what's going on if you just want to know. But if any of you are directly affected by GameStop, you'll understand where your next steps should be. Because hedge funds really don't manipulate the markets, nowhere near like they used to when I started. And in fact, hedge funds don't really do that at all. You obviously have your higher upper echelon hedge funds like the Melvin Capitals and firms like Citadel that have certain market powers, obviously. But there's a lot of smaller hedge funds with like a few million to $100 million in assets. Now, those are big numbers, obviously, but in the hedge fund world, they're small. And as I explain this, you'll understand why. In fact, most retail traders, or actually retail traders as a whole unit, over the last several years have outperformed hedge funds tenfold. Now, why is this? Well, one of the reasons, there's obviously lots of reasons. It's expensive to run a hedge fund. You got a lot of legalities. But I'm going to talk about two things here today that specifically stand out. Again, there's a lot more. I welcome your comments about this. Please let me know other things. But for the sake of time, I want to talk about what I feel are the top two things. The first, obviously, is restrictions that are placed on hedge funds. The ability that you and I have has never been better to make money in the market. We have the ability to change our fundamental analysis and approach every 5 minutes. We can go, I'm going to be a penny stock trader today. Nope, I'm going to be an option trader. Nope, I'm going to trade foreign currency. Nope, I'm getting me some silver. No, you can bounce around all that. It's not advisable, but you can. You can buy something in the morning and short it later on. You can scout for 33 cents and then you're out a little bit later on. You can hold, you can buy, you can sell. You have all of these resources at you. Hedge funds cannot do that. They consider the people that invest in hedge funds sophisticated investors, where the rules don't necessarily apply like they apply to us. So one of the disadvantages is how hedge funds can get in and out of business. Get out and out of stocks, I should say. So normally how a hedge fund works is it creates a prospectus to its clientele. This is what we are investing in. Technology, global markets, whatever they want. And they have to follow that. It's also very expensive because they have to hire attorneys to file all this paperwork and licensing requirements and bonds and all the different kind of stuff that goes on behind the scenes. But the main thing is they just can't get in and out of positions like you and I can. They're also into forced buying, which we'll talk about a little bit later, and how that has affected probably stocks that you have owned. So not having the ability to trade what they want, when they want, and being on a strict schedule obviously ties their hands to make money. Again, I'm not saying that I feel sorry for them. That's part of the business model. So getting in and out of something isn't so easy. The bigger issue, as you have heard with many hedge funds like the Series Billions, right, where you've got the market manipulating multi-billionaire cunning Bobby Axelrod. You've heard such great lingo as 2 and 20. Well, what's 2 and 20? Normally hedge funds charge fees. And to me, this is where the problem starts. Because a normal hedge fund will charge something like a 2% management fee. So whatever your balance is, you get 2% just as a regular fee. Plus, whatever profits you make is 20%. Now, this is a good deal for an investor if the stock market is going down the toilet, or this is a good deal for an investor if the stock market's doing nothing. So like when I started during the stock market crash, the 2001, after the 2001 market crash, the market remained pretty much docile for several years until the financial crisis came by. It didn't really have what you're seeing now. It took like 13, 14 years for the NASDAQ to make a high. Now you make a new high like every 4 minutes. But you spend a lot of years where the market was either negative or it only went up a couple of percentage points. Now, here's why this matters. Because back then, a hotshot hedge fund manager was somebody that could get 10%. So if the market's returning either negative or a couple of percentage points every year, and you've got this guy or girl running a hedge fund that's going to return you 10 to 15% consistently, well, it makes sense for people to pay those fees because they're getting a return. Now, after the financial crisis, I'm going to try to tighten this up as much as I can for sake of time. I'm obviously leaving some key details out here and there. I'll try to touch on the most important. But of course, we talked about this before as well. After the 2008 financial crisis, when the Fed created liquidity and doing the QE, you saw the market change. What had happened in this change is that the market started returning 10 to 20 to 30%, like the Qs, 30% every single year or on average. So now if you think about it, here's the hedge fund manager that could either be lazy or could be a hot shot on a 10 to 15% investment. And now would you pay somebody to get you 10 to 15%? So now when the stock market's going up 15% every year, if you're just buying the SPY and falling asleep for the whole year and reinvest in the divvies, then you're outperforming all the hedge funds managers. Now, what this creates is if you're a hedge fund manager, you now have to not tell your clients, but you have to expect that 10 to 15% won't do. If you want to keep these customers, you're going to have to get 35% and 40% returns. Now, what does that automatically do to them? Well, number one, they have to trade more aggressively They have to be more leveraged. They have to be more involved in the market. And you get into this case where they're all stampeding over one and another. And this is why you've seen not only record market growth, but you've seen record hedge fund failures over the last half decade. And who created it? The Fed. The Fed, by pumping money into the market, by keeping overnight borrowing rates low, has helped other things like high frequency traders or the larger prime brokers, not necessarily hedge funds. So hedge funds themselves are a dying business because, number one, retail traders have outperformed them. The restrictions on them to trade, as well as what the Fed has created by this linear bullish market that never seems like it wants to stop, puts the pressure on them. Now, also, how this translates into what you're seeing, while many people hate them, and again, I'm not a fan of them either, but if you're somebody that owns Tesla, Apple, Facebook, or many other growth stocks, the TTDs, the Spotifys, the shops, if you're somebody that's benefited over several years of massive 401k growth, who contributes to that? Is it all retail traders that's buying Tesla? No, it's not. Are they the ones buying the market? No, it's these hedge funds. So when you also see about the pressure to get returns, they also end up in positions that we tell new traders not to end up chasing. So also when you look at something like Tesla and you say, how does something not make any sense? How does a Tesla happen? Or how does a GameStop happen? Or how does an event happen that makes no sense? How does the market keep going higher and higher? Because the pressure is on them to continue to buy. And right now you're at historical lows where less than 2% of all the available cash held in institution is what they quote unquote on the sidelines, right? You always hear money on the sidelines, money that's not being used in the market. Well, all the money is in the market and it's continuing to be flooded in the market because the only way hedge funds can succeed is by being leveraged and leveraged as much as possible. They now have to become creative in this whole grand scheme of things. And that's why you see things like Tesla, because honestly, if you're a hedge fund manager and you're not outperforming the SPY, how can you look at a client and say, how come you don't have any Tesla? Where's your Tesla? You got to buy the Teslas. You got to buy the Amazons. You got to load your portfolio in those big names. This also brings me to the final part of this, is that's how something like GameStop really started. It wasn't really David versus Goliath, as many as you're learning. Now they can get the party started, this whole Wall Street Bets Reddit thing, but like I mentioned in my last video, don't be fooled. There's other players involved, a lot of other players involved. I would think, again, I'm not a reporter, so I got to trade and make money. I'm going to sit here and do research. Like I said back then, I think you're seeing a lot of this come out. It was hedge fund against hedge fund. It was another hedge fund that found that another hedge fund was vulnerable and found a way to manipulate them. So if there was any manipulation, it was hedge fund on hedge fund. So in a wrap up, guys, I know none of us like hedge funds. I get it. And I'm all for the little guy. But I got a few words of advice. The culprit in all of this is the Fed. Now, obviously, some of us have benefited from the Fed. We've got low interest rate mortgages that allowed us to buy a house. We can borrow money whenever we need it now. And stocks have made this incredible 12-year linear bull market run that we've never seen before in history. So many of the people that are complaining about the hedge funds are the very people that's the ones that made you rich by buying it. But also, again, I don't feel sorry for him, but the hedge fund business is a very difficult business to be in. It's expensive, it's very restrictive, and a lot of legalities have to take place. But more importantly, the pressure is on hedge fund managers to perform and outperform a market. And it's hard to outperform a 20 to 25% gaining market. And again, you've seen that with retail traders easily outpacing hedge funds. So honestly, you're going to get your wish. Hedge funds won't be around much longer. That business model doesn't work. And over the course of many years, you've seen more of high frequency traders and other type of clever trading institutions and stuff like that. So while I appreciate your anger, my last piece of advice is this. If you try to get stubborn up here and you're doing the whole diamond hand things, you're going to be broke. You don't need to do that. That's just stupidity. Take that energy, take that money, find another way to do it. I don't know. Protest the Fed. You guys are smart. You're young, you're energetic, you're enthusiastic, you're cutting edge. Don't do it this way. That's the wrong way to do it. You're just basically cutting off your nose to spite your face. It's not going to work. You're not going to shake anyone out here. Find a better way. Get out of that thing before it's too late. It might even be too late. It was 500 and now it's 50. Get out. It's going to zero. Okay. So anyway, guys, I'm going to wrap it up there. I hope I made some sense to you. Sometimes I have to babble on, but anyway, I hope I made some sense. Again, I'm not a fan of hedge funds, but hey, that's the business and that's the way it works. And it's not just so cut and dry to be pointing your fingers at one direction when the bigger culprit has always been the Fed. And obviously, with their $120 billion commitment every month into the market, you're going to continue to see the more same melt up BS that you've always seen. And I don't know if and when that ever stops. All we can do as traders is adapt to what we have and trade within it because we don't make the rules. But maybe someday some of you can make some new rules for us. So take care. Always don't forget about the part-time trader program. Give me your thoughts, feelings, comments, quarrels, curmudgeons, or suggestions down below. Until the next happy hour, cheers.